So besties, I recently ran a poll on Instagram and asked, what part of your financial journey do you struggle with most? I offered up topics like saving and paying down debt and budgeting, but the overwhelming majority of votes went to investing. And I know investing can feel super overwhelming because it's so jargon heavy. But today, I'm gonna break down investing into the simplest of terms using an easy analogy, and I'll also explain what to look out for to make sure you have the best portfolio. And if all that isn't simple enough, I'll even give you an easy hack to fast track your investing journey. Let's get to it. First things first, let me address the big question I always get. What exactly do I invest in? And the BFFs always think I'm gonna have magically just a list of the 10 best stocks for them to blindly buy just because I said so. I hate to break it to you, but nobody knows what the perfect investment is. Everybody wants to find the perfect investment. You, hedge fund managers, and billionaires alike are all looking for the best thing. And even though hedge funds and billionaires have endless resources, unlike us, they still can't seem to get it right. While I was a trader on Wall Street, I saw hedge funds blow up all the time because people made bad investment decisions. So please know, there's no such thing as the perfect investment. And in fact, we need to rewind. Before you worry about what investments you're gonna buy, we need to figure out what's going to hold your investments. So step one, you are going to pick an account. These aren't investments themselves, they are just online tote bags. They hold stuff. You can get a special tote bag like a 401k or a 403b, or an IRA or a Roth IRA specific for retirement. Or you could get a tote bag specific for saving for your kiddo's education called a 529. Or you could get a blank tote bag that you can access at any time called an individual brokerage account for general investing. You can research the account types that might make the most sense for you depending on your goals. When do you want to have access to that money? What are you investing for? And you're gonna open up one of these at any financial institution. This can be with your bank, a new fintech with a sleeker online interface if you're more digital first, like SoFi, which is what I opt for, or at one of the old traditional brokerages like a Fidelity, Vanguard, Schwab, or E-Trade. Then we move on to step two. Now you're going to fund the account. This is literally so simple. All you're doing is taking cash out of your checking or savings account at your bank or credit union and putting it into your investment account. This is done digitally, and most platforms just have you either link your bank account or connect it through Plaid. Simple enough. And last, step three, the fun part. We pick investments. And instead of telling you my top 10 stock picks, I'm gonna tell you how I buy hundreds of companies at the same time without having to spend a fortune. You're going to buy ETFs and mutual funds. In particular, I like index funds. Don't let these names or phrases confuse you. For the purpose of your investing, what you really need to know is that they are essentially just baskets of investments. Instead of just buying one company, you can access hundreds or thousands at a time. One thing I do want you to be on the lookout for when selecting these funds you'd like to invest in is the expense ratio. While trading platforms are no longer charging commissions for transactions, mutual funds, ETFs, and other baskets of investments still do charge a fee. I mean, someone has to do all the work of putting them together, or at least they have to fund the technology that does, right? And that costs money. And these fees are called expense ratios. It's a percentage that you'll pay on top of your gains or losses. For example, say an investment has a 0.1% expense ratio. If you make 8%, you'd actually make 7.9%. If you lost 5%, you'd actually have lost 5.1%. Expense ratios are important because sometimes similar investments have different expense ratios. For example, if you wanted an S&P 500 tracking ETF, you could buy SPY, but the expense ratio is much higher than VOO, which essentially does the same thing. By choosing VOO instead, you'd save money annually while accomplishing the same financial goal. And speaking of good funds that offer diversified investments, here are a few great options, but as always, this is not financial advice. I don't know your personal situation, and please do your own research. You can also choose to invest in a target date retirement fund if you want something more tailored to your age and how close you are to retirement. All you have to do is calculate what year you turn 60 and round to the closest year ending in 5 or 0. Then pick the target date fund with that year in it. My favorite analogy about investing is that it's like walking into a grocery store. Everybody has a different vehicle to hold their goodies. Some grab a basket, other grab the mini carts, other grab full-size carts, and heck, some people just hold all of their food in their arms. Some people being me. They come into the store with money and then buy things at the store. AKA, when you're investing, you choose an account to hold your investments, you put cash into the account to make those purchases, and then you buy stuff. But what if you've watched this entire video and you're still thinking to yourself, dang, I still don't really get it? Consider investing through a robo-advisor. This is the simplest set it and forget it investing method. So if you're lazy but you want to eventually be rich and get your bag, please pay attention. I'm gonna teach you how robo-advisors are just like your Spotify. So you know how Spotify uses your listening data to help build you the perfect playlist? You got stuff like Discover Weekly, Daily Mix, Release Radar? Well, robo-advisors do the same thing, except for your investments. You fill out a short survey about your goals, risk tolerance, and financial situation, and then they build you a personalized and diversified investment strategy. If you don't have the time or the willpower to learn how to invest on your own, this is a superb way to still invest without confusing yourself. My only flag is that robo-advisors do typically charge an additional fee. For human advisors, they charge around 1% to manage your money, but good robo-advisors charge about a quarter of that, so 0.25% or less. While you'll pay more in fees to use a robo-advisor than if you were to invest on your own, if you know yourself and don't think you'll invest, period, unless someone else does it for you, this is still a great option. To wrap up this video, I want to remind you of two important points. By parking your money in a checking account, you're losing wealth as the years go on, because inflation's gonna make your life more expensive. And unless you're making upwards of hundreds of thousands of dollars a year, you can't realistically save your way to rich. You need to invest your money if you plan on retiring. And two, please be gentle with yourself. Just because you haven't invested yet does not mean you're bad with money. You are not stupid, you're not behind, you just haven't ever been taught. We pride ourselves on dragging kids through school for 12 years, math, reading, science, history. But we don't teach personal finance when it's actually the most important subject that actually impacts every single person. I hope this video was able to teach you a little something you never got in class and also gives you the hope that no matter who you are, you can and deserve to invest. Make sure to like and subscribe for more money, investing, and finance tips. I love you guys so much, and I'll see you next week.